You've seen them, the YouTube and Instagram traders crowding your feed, shouting about massive daily profits from the driver's seat of a rented sports car. Their central pitch is irresistible. They promise you can trade with up to $100,000 of someone else's money. You take zero personal financial risk, but you get all the upside. The primary targets for these campaigns are everyday Indian retail traders, people looking for a way out of the daily grind and hoping for a genuine financial breakthrough. But let's look at the math. Market data shows that 95% of retail traders lose money. So why would any company blindly hand over hundreds of thousands of dollars to an absolute beginner? They wouldn't. This setup is a highly sophisticated psychological trap, engineered specifically to extract cash from ambitious novices. The ecosystem revolves around proprietary trading firms, commonly known as prop firms. These companies claim to be scouting for talented but underfunded traders to manage the firm's own capital. They offer an incredibly generous split. You keep 80% of the profits you generate, and the firm takes 20%. If the account loses money, the firm absorbs the loss. But look at real institutional Forex trading. It requires massive data infrastructure, rigid oversight, and teams of risk analysts. It looks absolutely nothing like a teenager guessing on a laptop from a beach chair. The no-risk promise is strictly bait. It lowers your guard so you don't realize what the actual transaction is. To get your hands on that $100,000 of capital, you first have to pass an evaluation challenge. Taking this test requires an upfront evaluation fee, which can range anywhere from $50 to $1,000. This chart shows the first mathematical hurdle, the profit target. You are required to generate an 8 to 10% return in a single month. For context, massive institutional funds often aim for 20% in an entire year. At the exact same time, the firm applies a strict daily loss limit, or drawdown rule. Drawdown measures the decline from a historical peak in an account. If your balance temporarily dips by just 5% in a single day, you fail. Then comes the real trap, the trailing drawdown. In these challenges, as your profit goes up, your loss limit rigidly shifts up right behind it. Your margin for error actually shrinks the better you perform. Markets naturally fluctuate. A perfectly normal downward dip, standard market volatility, will easily cross that elevated trailing limit. The moment it does, your account is suspended instantly. These rules force traders to take oversized risks to hit an extreme profit target, while simultaneously giving them zero room to absorb normal market movements. The system mathematically guarantees a blown account and a forfeited fee. If the math guarantees failure, why do so many prominent finance influencers push these challenges on their subscribers every single day? This diagram shows the affiliate commission structure. When you buy a $500 evaluation challenge using a YouTuber's link in the description, 15 to 30% of your fee goes directly into that influencer's pocket. Because 95% of participants fail, those same users inevitably buy a second, third, and fourth challenge to try again. This triggers endless commission payouts for the promoter. These influencers are not trading mentors. They act as commissioned salespeople, profiting directly and repeatedly every time you fail. Defenders of these firms point to Telegram channels flooded with payout certificates and withdrawal screenshots from the 5% who actually pass. But when those successful few try to withdraw real cash, the firms pull out the fine print. They deny payouts, claiming the user traded during a news event or violated an obscure rule about trading style. We recently saw massive prop firms like Forex funds and funding pips suddenly freeze operations. They shut off their servers overnight, facing fraud allegations and vanishing with millions in trader fees. Those few successful payout screenshots you see online are effectively a marketing expense. They are necessary illusions to keep the mass volume of evaluation fees rolling in. We need to stop looking at prop firms as financial trading institutions. They operate entirely as e-commerce operations. The firm's actual product is the evaluation fee itself. They are not making their money by sharing the profits of successful traders. It is a high-volume business model that absolutely requires a 95% failure rate to sustain its revenue. The system functions exactly as designed. Extracting continuous fees through rigged math is the core business. There are no shortcuts in the stock market or Forex. Quick wealth is a myth. The flashy Dubai lifestyle promoted by these internet gurus is funded by the failed challenges of retail traders, not by their own trading mastery. If you want to learn, start with a small amount of your own capital, even 5,000 rupees. Build real risk management skills in an environment where the rules aren't stacked against you. Share this video to protect others from the influencer pipeline, and subscribe to the channel for more financial reality checks. In the modern financial internet, if someone offers you a risk-free path to a fortune, you aren't the investor. You are the product.